Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Tuya Inc. Annual Report. Tuya Inc. offers a wide range of businesses and services that cater to various needs of its clients. At the core of its offerings are AI cloud platform services, which provide a foundation for integrating AI capabilities into devices and applications. The company's Tuya Open framework enables developers to create smart solutions with ease, while its universal AI agent engines facilitate the integration of AI into various industries. The company provides physical AI solutions for smart devices, commercial applications, and industry developers through its cloud computing and spatial intelligence capabilities. This includes the development of AI-powered companion devices that utilize cellular connectivity. Furthermore, Tuya Inc. fosters a developer community that collaborates to create smart solution ecosystems, embodying principles such as sustainability, security, efficiency, agility, and openness. The company's services can be broadly categorized into several key areas: AI cloud platform services, physical AI solutions for smart devices and commercial applications, industry-specific solutions through its universal AI agent engines, developer community and ecosystem development, strategic partnerships with companies like Shanghai Luobo Intelligent Technology Co., Limited. Unfortunately, I don't have access to the text you provided. However, I can still provide a general overview essay on what might cause a stock price to drop. The stock price of Tuya Inc., a Chinese technology company, has dropped significantly in the past year due to several factors. One major reason is the decline in investor confidence following a series of regulatory challenges faced by the company. The Chinese government's increasing scrutiny of tech companies and their business practices has led to concerns among investors about the long-term viability of Tuya's operations. Another factor contributing to the drop in stock price is the slowing down of China's economic growth, which has impacted the demand for Tuya's products and services. As a result, the company's revenue and profitability have suffered, leading to a decline in its stock value. Additionally, the rise of competition from other tech companies has also played a role in Tuya's declining stock price. The increasing competition in the smart home and IoT market has made it challenging for Tuya to maintain its market share and pricing power. Lastly, the company's high valuation and lack of profitability have raised concerns among investors about its ability to sustain itself in the long term. As a result, many investors have become cautious and are selling their shares, leading to a further decline in the stock price. Tuya Inc. market capitalization of $12 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that Tuya Inc. holds a significant advantage in their industry. Tuya Inc. trades at a higher price-to-earnings ratio of 30 times and a higher price-to-book ratio of 1.46 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation, signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The balance sheet appears very conservative, with liabilities representing only 9% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 4.69%. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth for a company can be identified through various metrics. According to the extracted summaries, 3 key areas have contributed to revenue growth: Platform as a Service (PaaS), Software as a Service (SaaS) and others, and Smart Solutions. Specifically, PaaS revenue has increased by approximately 6.5%, SaaS and other revenue has risen by around 13.4%, and Smart Solution revenue has grown by about 8.9%. On the other hand, the primary drivers of decline are not explicitly stated in the summaries. However, it is mentioned that a decrease in operating expenses led to an increase in non-GAAP profit from operations. Additionally, foreign exchange risk and interest rate risk have been identified as potential factors affecting revenue growth. The former refers to fluctuations in the value of the RMB against the USD, while the latter relates to changes in market interest rates impacting interest income. The financial performance of the company has shown significant improvement in both net income and profit margins over the past year. Net income has transformed from a loss of $47.6 million to a profit of $11.5 million, indicating a substantial turnaround. This increase is also reflected in non-GAAP net income, which rose to $33.7 million. The improvement in profit margins is equally impressive. The operating margin improved by 19.5 percentage points to 3.6%, while the non-GAAP operating margin increased by 2.9 percentage points to 10.5%. Furthermore, the net margin jumped to 18% in 2025, a significant improvement of 16.3 percentage points from the previous year. The consistency in non-GAAP net margins between 2024 and 2025 suggests that the company's financial performance is stable and reliable. Overall, these changes indicate a substantial shift towards profitability for the company, driven by improved operational efficiency and effective management strategies. The company's financial performance indicates a significant improvement in its ability to generate cash from its core operations. A key indicator of this is the net cash generated from operating activities, which stands at a substantial $81 million. This positive operating cash flow is a testament to the company's efficient management and effective execution of its business strategies. As a result, the company is now in a stronger position to invest in growth initiatives, pay off debts, and reward shareholders with dividends or share buybacks. Overall, this development bodes well for the company's future prospects and provides a solid foundation for long-term success. The company's financial situation has undergone some changes over the past 2 years. One notable shift is in its lease liabilities, which have decreased significantly from $3,798,000 in 2024 to $1,985,000 in 2025. This reduction indicates a more manageable financial burden for the company. However, there has been no significant change in the total debt level between 2024 and 2025. The lack of variation in this area suggests that the company's overall debt remains relatively stable. Unfortunately, information on interest expenses is not provided, making it difficult to assess any potential impact on the company's financial health. Management is optimistic about the company's future prospects. They are focusing on a key account strategy to serve strategic customers, which will likely drive growth and revenue. The company is also expected to see improved profitability and operating margin, indicating a strong financial performance. In terms of liquidity and working capital, management is confident in the company's position, with plans for potential acquisitions to further expand its operations. The allocation of net proceeds from listing will be used to support marketing efforts, partnerships, investments, and general corporate purposes, demonstrating a commitment to growth and development. Overall, management's outlook suggests a positive trajectory for the company. The company's financial records clearly indicate that it has a history of paying dividends to its shareholders. This is confirmed on multiple pages throughout the document, with specific details provided about the dividend amount and payment dates. The declaration of cash dividends is explicitly stated as yes on page 13, further solidifying this fact. Additionally, page 23 lists the dividends declared in 2025, including the amounts and total payout, demonstrating a consistent pattern of dividend payments by the company. That concludes the financial summary for Tuya Inc. Feel free to comment below, and I will be happy to answer them when possible.